Hi, thank you, Richard. Hello, everyone. So nice to spend the morning with you. And I saw a lot of familiar names on the list, so not going to single out anyone other than to say thank you to Richard and Jonathan for the opportunity to share the next hour with you. Just talking through again the business assurance risks, how we should understand them, solve them, and just a little bit of a refresher. As Richard said, please stay in here for the whole meeting so that we can allocate your CPD certificates. You also just need to ensure that you have registered. You'll see it's always difficult for us when we work with these online sessions because your computer name may not always be complete, so it's sometimes difficult to identify you. So just make sure that you've registered. Jonathan, if I can ask you, just because my screens are busy, if you could just post that forms link in the chat for the guys who didn't register. That just helps us with your personal information because we need to include that on the CPD certificates. All right, and then you can expect to get, let's say, in the next week, your CPD certificate for attendance, as well as a copy of the recording. I'll distribute that at the same time. And what I'll also do is include a copy of the presentation in case you want to refer to that. Okay, so you need to stay in for the full session and then one CPD point awarded afterwards. Okay, so just before I start, and thank you, Richard, for that introduction, we have an arrangement with ColLab where we assist with more complicated deals. So if you want to take that up, you could just deal with us through your broker consultant, get the necessary approval for the intervention, and then we will, excuse my roaming eyes, but I'm also opening the door and keeping an eye on the chat as we go about. So your consultant will then arrange for support, and I'll talk about what it is we can do to support you towards the end of the session. So in the next hour, quickly, just a refresher on the different business risks, how we should understand them and where we should start. I just want to go over the tax implications and the estate duty implications quite briefly. And then, as Richard said, we'll work on some follow-up workshops to delve into a lot more detail. All right, so today I'd like to refresh quickly the different business risks and how we should be solving them. In other words, the correctly structured solution. I'll also just refer to the supporting contracts that we attach to that. But I think most importantly, where we start, in solving our business needs, there's so many things that we need to address. So where do we start in terms of that? Maybe just for those of you wondering, the logo that you see on the screen is Avalon. That is our software that we have in the market, used by many insurers, many banks, many independent advisors, not specifically only, but to solve risks. And a big component of the tool, in actual fact, the first one that went to market, is our business assurance component. Okay, so if we look at these multiple things, we know concepts like contingent liabilities, we know about loan accounts and key person policies and buy and sell and partnerships, insurance and whatever that is called. We need to know how to present that to our clients and also where we should start. Okay, so maybe just before we do, just a quick 2-minute background on Allegiance, where we come from and how I fit in. As Richard said, we're an independent legal services company. We specialize in the financial services industry. And I think we have a lot of experience within the team. I've been in the industry for almost 30 years now. So you feel like an old baboon with a long chain or something like that, I believe. We also act, specifically myself, as expert witness in court cases, never our own, fortunately. But when we need to provide evidence to the court on how a specific matter is handled, we like to get involved there. So that helps also to identify what the things are that eventually end up in court and how we could potentially prevent that when we give advice to our clients. My speciality then is estate planning, the whole fiduciary landscape attached to that. That includes the estates, trusts, etc. And also a business component. I don't know, it's because we're in Joburg, but I certainly have most of my clients' first consultation is because they are business owners. So go back to your own practice. If it's something that you don't focus on or haven't focused on traditionally, it's actually very easy to solve risks and do business in this component of the market. Okay, so we've done close to 1 trillion rands worth of opportunities identified in this specific area. We've seen almost 300,000 clients, and we've done a lot of research in terms of business assurance. And it's always difficult to say, what risk or what event is more important than the other. So on the screen, you'll see kind of our matrix in making that decision. And it's all about events that could have an impact on your client's wealth. So if you look at the events listed there on the left-hand side, a death, a disability, retirement, severe illness, divorce, immigration, sequestration, etc., of a business owner and or a partner in the business will have severe consequences then on the continuity of the business necessarily. So obviously, first of all, it affects the person that goes through this particular event, but the secondary effect is that it has an impact on the business, the remaining owners or staff that stay behind. Now, if you look at my list on the left, some of these events obviously can be insured. And if you go back to the right, to the building blocks of insurance, it is actually to soften the impact or to manage the financial consequences of a particular event. Some things you'll see the bottom couple of items on that list, like a divorce and immigration or sequestration, unfortunately cannot be insured. So those are the things that are very difficult to manage. Think of a business where one of the partners decides to immigrate, and that results in his or her skills being lost in the business. It's very difficult to protect the business against that. I now have an estate where a person is insolvent in his personal capacity in the estate, but is also a co-owner in another business. So that now has impact for that owner because I need to extract half of the value of that business. So some of these things are often very difficult to manage, but the things that we can insure are the things that we can then manage the impact of. All right, so based on this, on the consequences, not only for the affected person, but also for people around that person, we've developed the matrix that you'll see on the board now, where we've kind of prioritized what should happen first. And I just want to talk you through the table quickly. It's a very easy conversation then to have with your business client because you've almost got a recipe. What is the first thing that I should check and quantify and talk about? And so we go through the list. If you think of doing something similar for personal planning, it would be very difficult because every client has a very unique situation and very unique circumstances. And it's not always easy or possible to plot it onto a summary like this. But when it comes to business assurance, there is actually almost a recommended priority in terms of your discussions. And you'll see here we've linked those priorities. And if I could just focus your attention maybe to these three columns, we focused our attention on where the impact hits highest. And if the impact is high for the business owner concerned and the remaining owners, then we've moved that to our priority level 1. So one of the first things you should be checking with your business client is in fact their exposure to possible contingencies. And I'm always surprised when I get to clients and they have solutions in place already that these things were never discussed or quantified or even considered. So it's also the most difficult one to quantify because I find that business owners don't always understand the impact or the implication of signing personal surety. As such, then there's also not a central place like the financial statements or a central portal that we can go to confirm a person's exposure. And this is what makes it potentially very difficult. There are a number of misconceptions as well around contingent liability. So I'm going to talk you through them so that you can understand what they are and how we should manage them. All right. Oh, thank you so much for posting that link. Remember, if you haven't registered, please just do that for us. And then I will be keeping an eye on the chat. So if you have questions, post them and we'll deal with them as they come on. So contingent liabilities then for us is the absolute first priority. And if we look at the advice that you give to clients and how we defend our advice to clients, it's also important that we document these discussions and the fact that the client has indicated perhaps that there are no exposures. Sometimes my financial advisors want me to remove this from the report if there's no exposure, and I think it should stay there because it shows that we had a conversation and at a certain point in time we quantified the possible risk, even if it's a zero balance. Okay, our number 2 risk then you'll see is the credit loan accounts. So this is where a business owner puts his own funds into the business. And obviously when he dies or becomes disabled or comes sick or wants to retire, he would also like to extract this credit loan account that the business owes to the individual. I'm going to chat to you a little bit in more detail when we get to that item. Our third level conversation then, or our third priority, is to say, we've protected your personal estate against any personal surety spillover that might come at a detriment to your family. We've then allowed a mechanism for you to extract any credit loan accounts in the business without affecting the capital structure of that business. And number 3, now we want to talk about the continuation or not of that business. And the buy and sell discussion or the equity discussion is relevant to multiple business owners or just a single business owner. I think we forget to have this conversation with our single business owner, whether that's a professional, a sole proprietor, a sole member of a CC, or 100% shareholder in a company. So I'll delve into a little bit of additional thoughts there as well. So those 3 then is our first priority. We move on to our second priority discussions. Those are, who are the people that are relative and important for your business to continue to earn an income? And how do we protect and quantify those people so that we have, again, financial backing if we lose that person due to a death or a disability, possibly. Okay, our number 5 risk is then a debit loan account. So that's the opposite of our credit loans. This is where the individual or the shareholder or the business owner owes money to the business. And obviously that needs to be repaid or recovered if something happens to that person. And you'll see here, it has a medium impact on the business because it has been without that capital. So it's not necessarily a high impact. But we need to recover the funds that are outstanding. You'll see for the person that has died, it has a very high impact because it's a liability in their estate, and we need to provide for that liability to be paid. If we don't have liquidity or sufficient liquidity, it might mean that we need to sell assets that are ring-fenced or earmarked for a different purpose. And then you'll see also a medium impact on the remaining owners because the capital has been removed from the business already. We kind of say that the business operates without the capital, so whether they recover it or not may not close the doors. Okay, but very important that we provide for a mechanism. Number 6 is then our overheads. What are the things that continuously run and what are the things that we continue to have? It has a very high impact for the business if we cannot service these overheads while someone is not well, possibly disabled, or who has passed away. So the importance here is we've dealt with all of the other matters, but we also need to provide a method to keep the doors open. I had a chat to another client yesterday, an advocate who practices in her own name and who has a lot of overheads in the business. And we said, although that practice can't really continue, we might want to provide some form of income for the overheads while she's not well. Okay, so there may be situations that is not obvious, but where we still have this risk. And then what we did in number 7 is we said, how do we close this conversation around business assurance and bring that back to home? Because if you think of a client with a business interest, that's only one of the assets in his portfolio. It may not be his entire portfolio. So now we need to just step away from the business a little bit and look at what the individual requires from an income perspective for the family, perhaps, so that we can bring the capital adequacy into the calculations. So here we're trying to close the conversation between having a business assurance discussion and having a personal discussion. And we've allowed a very easy way to almost have a boardroom discussion around this without having to go into too much detail. I want to use a firm of engineers that I saw north of Pretoria a little while ago. Very reluctant to meet with us the first time because they said they've got insurance and everything's under control. And we said, okay, that's fine. We'd just like to come and do a health warning. Now, the reason they were reluctant to give us the appointment is one of the 26 shareholders' daughter was the financial advisor to the business. And that turned out to be a very, very difficult decision, and I'll tell you why now shortly. So we said, let's health check, and we sat with the 26 shareholders. We got them into the same room. We spoke about the risks and what should be in place. And the result of the health check was that they had done nothing about their contingencies and they had huge exposures. There were quite a sizable amount of credit loan accounts payable to individuals, and they also didn't talk about what had to happen there. They had a buy and sell agreement in place, but it was completely structured incorrectly. And they also had key person assurance in place, also not structured optimally. So what I did, and it was a little bit purposefully, is I calculated what they would net out with their current scenarios. Just a comment or two about the buy and sell. They had entered into a buy and sell that was in direct conflict with their MOI and shareholders agreement. So my question to the board was whether or not they would successfully be able to sell their shares if that agreement was in conflict with other preceding agreements. So the bottom line, after taking off all the unnecessary layers of tax that was caused by an incorrect policy structure, they had 32%, most of them between 30 and 35%, but an average of 32% of the capital available that they thought they had. So 70% of the capital had gone astray simply as a result of a structure that was not done ideally. So hopefully our session today will point out what these things are and how the structure should be done in order to avoid unnecessary expenses like those. Okay, so I'm going to break them down, and I'm just going to go through each of these risks in that order and just let you have a few thoughts about each of them. Okay, sorry, I'm just opening the door again. Here we go. So contingent liability, let's understand what that is. And it mostly centers around signing personal surety. So what you'll see happens in most cases, we have a business that requires funding. So they will go to the bank and say, we need funds to expand, maybe do capital expenses. Maybe we want to finance equipment or stock or vehicles. Maybe they have a need for an overdraft. So there's many reasons why you would go to the bank or another similar institution to acquire funding. And usually the business doesn't have a strong enough balance sheet to support that application on its own. And what the bank will then say is, we'll give you the facility, but we're going to call for personal surety from one or more or all of the owners. And that surety will then also be to the bank. All right, and what we need to look at is that these personal sureties are much wider than just an overdraft facility or finance arrangements on your assets. The dangerous thing with personal surety, though, is that there are a number of events in which that surety will automatically, without warning, without consultation or consent, be called in. And the first one is when the organization, when the business, fails to settle payments on debt timeously. The bank will then call it in. Now, if we have a death or a disability, something similar happens. the bank has the first right to call in that surety. So let's just use the overdraft as the obvious culprit and say your partner's died, we're calling in the facility. So that has serious impact for the business, and it has even more serious impact for the individual that has provided personal surety. Okay, but clients believe that this happens only after other things have happened, and clients also believe that they can just renegotiate this. Now, the renegotiating is easy if you have a suitable replacement, but if you don't, and that's often the case in businesses, then that facility might be called in. And then obviously also when you fail to make alternative arrangements with your creditor, then they'll call in on the surety. And the difficult thing now is that all of this happens while you're trying to wrap up a personal estate. Could really derail things quite seriously. So let's just have a look at what happens when you sign surety. The first thing that we maybe need to look at is that sureties are always, I've seen in my 30 years, only 2 single sureties, but sureties are mostly joint and severable. So what that means, and Richard and Jonathan, I'm going to use you as examples of my partners. The 3 of us have a business together, and let's just say, to make it easy, we each have 1/3 of the business. That surety for our R1 million facility is shared among us evenly, but also jointly. And that means that the R1 million can be recovered from either of us, either from Jonathan or from Richard or from me or from the business. Or if they struggle to collect from one person, they can split it up. But there's actually no limit in or correlation to your ownership in the business. And I'm going to give you the legal justification for that shortly. The second thing is that sureties, personal sureties, where you bring your own balance sheet in as guarantee, those are usually what we call unlimited. So that means the surety or the quantum or the amount may not necessarily only be the R1 million surety. It could actually run up to be a lot more. It could include the cost of recovery. It could include the unpaid interests and the penalties on that facility because we're in default. So these things are very difficult to quantify often. Another consequence is the third one, is that it's not linked to your ownership in the business. So let's say, in my example, Richard starts the business up. He starts off by having 100% of business. He later brings Jonathan and myself in at 20% each. His surety might still be in place because he signed it on his own. Or if the 3 of us were included in the transaction originally, we will all be liable for the same amount. A lot of business owners seem to think that it's linked to their percentage ownership in the business. If I'm a 10% holder, then I'm only liable for 10% of the debt. And that would have been the case if the wording in the session wasn't what it normally is. And I'll show you what that is quickly. And then the last one that's extremely important is that risk remains there until it's cancelled by the bank in writing. And there again, I have a couple of cases that I was called into that I can provide you with evidence and examples and facts of how that happened. The last one was the lady that got divorced 12 years ago. She got home one day and she had a sheriff's letter stuck onto her gate to say that they'd come to claim surety for a default of her former husband. She had been divorced from for 12 years. His business went belly up. And because she signed surety when they were married more than 12 years ago and was never released, the bank called the surety up against her. So the long and the short is she had to take a second bond on her property to pay for the husband's debt because she didn't want to lose her house. And then she had a whole legal process of trying to recover that from him and from the business. So we need to make sure that we understand what happens here. And there again, in my 30 years, only 3 cancellations of sureties that were done in writing. The one was my brother. When he exited his business, I said to him, I want you to pursue this and you won't stop until you have it. And that was a really difficult task, but he managed to get that cancellation from the bank that the surety is cancelled. What partners sometimes do, I just want to switch my volume off. What partners sometimes do, let's say in a termination event, is they would agree among each other that that surety is no longer valid. But obviously, if the surety is not given by the partners, they are not in a position to negotiate it being cancelled. So it's very important that our clients are aware of the fact that it is cancelled. Another example was where a business owner signed personal surety for his sister's son. He required finance for his studies. He signed surety at one of the banks, and years later, they came to call in the surety. And it was not for the study loan, it was for subsequent debt, but he was exposed in an unlimited way, and that surety was never cancelled. So this thing is very dangerous if we don't understand the consequences. Okay, so let's look at the legal terms contained in a surety agreement and why it's so dangerous. If you look at the first word, which is called excussion, you renounce, a synonym for that would be to give up. You renounce, you give up the benefit of excussion, and excussion means almost that sequence of how we claim for a liability. Excussion would mean we claim from the business first, and if that's an empty judgment, we go to the next level. You will see in personal sureties that they remove that benefit, and that's why people that sign surety are as exposed as the business. All right, so very important that we bring this to our clients' attention. The second thing that you've renounced or given up is the benefit of division. So if you're a 10% shareholder, you are liable for 10% of the debt, normally in your shareholders' agreements and so forth. But what happens in a surety is you renounce that benefit, so you actually give it up and willingly say, I'm now responsible for 100% of the debt. And then the last thing that happens is you're lifting that corporate veil. In legal terms, the corporate veil is the separate entity that you enjoy. For a CC and a company, it's a legal personality. It's separate from the owners of the business, but you actually pierce that protection. And a lot of clients also don't understand that. They think if the business fails to pay the overdraft or the debt or the finance on the trucks, then they will just liquidate the business. But that personal surety actually pierces that corporate veil. Right. So how do we solve this? And maybe before we look at the solution, think of things that, like, I always start at the top. If your business owner is in a premises that they own, there's a bond, there will be surety. If they're in a premises that they don't own but that they are renting, then there's a lease agreement, and someone would have signed personal surety. Usually for a shorter time, because lease agreements are usually from a year to 2 years to 3 years to 5 years. Okay, so there's surety in that. Then I have a look at what kind of business they do. Let's say they're in transport and they have trucks, then there's surety for those kind of arrangements. Or let's say they're in sales and they've got stock and supplies, then there might be sureties for that. I also look at infrastructures. The cost, for example, of putting a switchboard and a PABX and computers and printers in place comes at a huge cost. And you'll see in those finance agreements as well that personal surety is signed. So there's many aspects, I think, in business that potentially provides that exposure that our clients may not be aware of. And what we also see in the figures is that our clients don't get away from that surety. If you look at, let's say, a logistics company, by the time they've paid off these very expensive trucks, they need to replace them again. So they're continuously rolling into these kind of exposures. Right, so how do we solve it in the most effective way? So here's our 3 partners. The first thing that we'd like to do is once the funding is approved and we know that there's an exposure, we'd like the business to take out a policy on the owner's life. Okay, so your proposer or your applicant is the business, and the life assured will be the person that has signed security. What we recommend as well is that this policy is then ceded to the bank in security for that loan. Now, sometimes we do and sometimes we don't, but that just ties the loop up quite perfectly, because now we don't have a situation where someone's passed away and the business uses the funds for other reasons. All right, and that's why you'll see there at the bottom, we suggest that there's a signed contingent liability agreement in place. And that agreement then will be in addition to this finance agreement, but it's basically an agreement between the business and the owner, so that they can confirm there's cover in place for a specific reason. Okay, so just some of the clauses in that agreement that we would draft. We acknowledge here that company is aware of the fact that the shareholders have signed surety on behalf of the company. We say here that they want to protect the personal estates from having to pay that liability. And we also say here that they want to ensure a release of the personal estate. So it's very clear, and we confirm the intentions for taking out that cover. This just helps if you have a partner that runs away with the money or doesn't use it in the way that we intended. Then you'll see there's another clause in this agreement that says when a shareholder dies or becomes disabled, in this example, the proceeds that will be paid to the company will be applied in a specific order. So firstly, we will pay the holders of any suretyships so that we can ensure a return of that surety. In other words, we pay the bank whatever is outstanding. So let's say there's R1 million overdraft, and when I die, we're sitting at 200,000. We'll use 200 of the million, and we'll make sure that that surety is paid and released. Second thing is we will just want to let someone in quickly. Thank you, guys, for helping with the door. The second thing is we will use the amount owed. We will use that payment also perhaps to pay credit loan accounts where there's a loan account or some other outstanding obligation from the company to that shareholder. And if we have any funds left, the company can use it at its discretion. Many court cases where the life assured's family take the business to court and say, you've received a X million rand policy and there's no reason for you to have it. So we just want to confirm that the life assured or the owner, director also signs the agreement. And then we want to talk about what we do with that policy. If the person is no longer exposed or leaves the business, then we give them a right to take ownership of that policy with them. Okay. All right, so just confirming a few things so that we don't have a difficulty or a dispute afterwards. Okay, so a useful document could be your financial statements, but think of an overdraft. You might have R1 million overdraft, and at the end of the year, you're actually in the clear. So that doesn't necessarily always show the exposure. It's also nice to have a look perhaps at the surety agreements, because your client might bank with multiple banks. He might have finance with multiple organizations. So very good maybe just to have that as well. Very, very, very important comment for the day is I don't think you can give any business assurance advice if you haven't asked for a copy of your memorandum of agreement, your shareholders agreements, and possible association agreements. Whatever advice we give to our client needs to talk to a pre-concluded and a very strong agreement. I want to say, and I'm not going to have time to spend on the flowchart, but very important to confirm how our business owner is married or not married. And you'll see in the next slide, it's very important here to understand the marital regime in South Africa as it stands at the moment. As you know, there's some changes coming, and we'll communicate any changes to the slide. Roughly speaking, if they promulgate what is in the bill at the moment, it won't be very different. But we need to see, if I'm married under the old act and I'm opposite sex, is it my marriage in or out of community? Because if I'm married those marriages were registered or not. If they were registered and there's no ANC, then it will again be in community and a potential co-exposure to business debt. Very dangerous if we have our in community or deemed in community marriages. Okay, so make sure you ask questions. When you deal with your business clients, we sometimes don't ask the question because we think it's not relevant to business, but it actually is very important. And then also very important to understand the family relationships between owners. I sometimes forget to ask, especially if they have different surnames, but we also need to know if there's a connection between business owners. And you'll know that that's got to do with the estate duty exemption or not in family companies. I'll get to that shortly. All right, often handy just to get copies of the suretyship agreements, especially when the covers become very big. These could be supporting evidence to your financial underwriting. Okay, so for a correctly structured solution, you should not have any income tax implications. So our recommendation is don't deduct the premium because you actually won't qualify for it. And then we know the proceeds will pay out free of tax. You should also not have any CGT consequences on that policy because you want that to be structured correctly from the start. And then our last point, you will see that we always provide for estate duty because we know that the exemption will probably not be achieved. So if you need R1 million cover, we're going to suggest that you take 1.25 so that there's extra money available to pay to estate duty. Okay, next point, and I'm keeping an eye on the questions, is risk number 2, which is our credit loan accounts. Now, our credit loan account, you'll see we have two types. Where the business owes you money is a credit loan account, and when you owe money to the business, that would be a debit loan account. So I see credit loan accounts usually when a business is started and it doesn't have its own money. The partner will put in capital or IP or stock or equipment or whatever it is. It's not necessarily always money. And I see the debit loan accounts often where we are selling to a younger generation, an older generation selling to a younger generation, and where they don't have money, they will then pay it off through dividends. I also see this in BEE transactions. There's actually a repayment process through debit loans structured. Right, so the questions we must ask our client is how are we going to get the money back? For the individual if it's a credit, or for the business if it's a debit. And how long will this take? Because the speed at which we are able to repay that will have a very direct effect on how long it takes to wind up that estate. And then another question could be, how will the repayment of this loan account affect the business? Again, a lot of business owners are not too worried about loan accounts, or they never think that they'll have to repay it. But they need to look at what the consequence is of having to dip into liquidity, and if there's no liquidity, possibly to sell assets in the business to provide for repayment of that loan account. So when you force a business owner to stop and just think and consider the consequences, they are often quite worried about this point as well. Again, look at your business agreements, look at your MOIs to make sure that you are giving the right advice. Often the MOI has certain conditions or processes around payment of loans and possible exposures. All right, so if we look at then the financials, this one is a very easy one to quantify. You could go to the balance sheet of your business, you'll go to the liability section, you'll probably see a note number. In this case, we've got a R3 million loan account. If you check in the note details, you'll see exactly who it's paid to. So this one's very easy to identify. I'm going to talk you through 2 ways in which we can repay that loan. The first one is the company owns the policy to pay the obligation, or on the right-hand side, you include the loan account in the buy and sell. If we have a company-owned policy, that liability is paid, it's gone. It improves the net asset value of the business. If we include it in the business buy and sell, it will not disappear from the balance sheet. It will just change names, payable to Richard instead of payable to Deirdre, because Richard bought it. All right. For the company owned, the company will pay the premiums, and for the partner one, the partner will pick up the premium. All right. So there are certain consequences. I would say there's no right or wrong between these two methods. It absolutely matters what your client wants to achieve, where they want to have the expense, and how they want to structure what they do. Okay, I'm going to speed up a little bit, otherwise we might not finish. Number 3 is having a conversation with your client around equity. All right, so you have a percentage ownership in a business, 100%, 10%, whatever it is. What happens to that equity when you're not here? So buy and sell, for many reasons, offers a lot of security, I think, not only to the person who's passed away or become disabled, because he can't talk and have a say in terms of the value. It often also offers security to the remaining partners, because they know who will be left and who remains and how they will deal with that. And you'll see in our suggested agreement, it's about creating certainty. We want to create certainty about what it is we're going to have to pay, because we'll fund that with a policy. We're going to create certainty about how it's paid, because we know where the money will come from. And we also create certainty around duration of the sale, because we've specifically agreed on terms. And the advantage then for your personal estate and for you as a financial planner is you can clearly qualify the capital gains tax that will be payable and the estate duty, and you can easily then see what estate liquidity would look like. So if we compare a buy and sell to a will, you'll see there's a lot of similarities. It's also a legal document. It must have the right clauses in it. It must be dated and signed. We need an original. It must be stored in a safe place. It looks at your wishes, because when you are party to a buy and sell, you don't know whether you're going to buy or to sell. And ultimately then for the benefit of your family. Okay, there are complications that we would obviously look at. So if you have a request for buy and sell and it's complicated, then get us in. We'll help you with the right structure and supporting documents. Okay, so just bear in mind that your preemptive rights that you find in your MOI or your shareholders agreement, the right of first refusal, that is not an obligation. It's still a choice. So a lot of business owners feel that this is their buy and sell agreement. It only creates an option to offer the shares to partner. It doesn't create an obligation. Have a look at your MOI. As I said, very dangerous to give business assurance advice if you haven't checked these documents. If you get requests for share buybacks, I would strongly advise against that, and get in touch. We'll share some reasons around that. So that was our 3 needs: our contingencies, our loan account, and our equity. Let's look at how it stacks up. If we've insured those 3 risks, and if we haven't insured the risks, you'll see there's a 10 million difference for this client. So we've insured 2 million surety. It won't be claimed against the estate. We've made sure that he could take out the 3 million or recover the 3 million loan account that he had. And we also said we're going to make sure that you can extract your 5 million rand cash value. All right, so very important to show the client the consequences of that. I'm going to rush through our second priority. Key person you will be very well aware of. Those were done because we actually need to quantify the price tag that we put on this person's head. So we use potentially 3 methods. The first one you will be very well aware with, or very comfortable with, and that's the multiple of earnings, up to 7 times annual income. So that's the easiest one. But sometimes you have a need for more cover on a person's life. Then we would use a method where we look at revenue, we look at what expected losses we've calculated, and we also look at the time to recover or replace that person. And this will give you a certain figure at the end. Another method could be to look at the cost of replacement. Where do we find another person? Do we pay a recruitment agency? Do we relocate? Do we build in sweeteners like sign-in bonuses, etc.? Okay, so this is our fourth priority. I've got a question here from Vanessa. We do happen to get a few quotes requesting buy and sells and do include share buybacks. Is that a different structure? Thanks, Vanessa. Yes, share buyback is a very different structure with very noticeable consequences, and I think it's important just to highlight those for clients when they do ask for it. My experience have been that the reason for buybacks are often not the right reason. Sometimes and very often they are called for because they don't trust their partners, so they want the monies to go to the company and the shares then to be bought back. There's different ways to skin a cat, or they don't want to share the premiums or contributions for the buy and sell as they should. So they think if they push it through the company and make the company buy the shares back, that they've solved the problem. So chat to us. I've got a very nice document that I can share with you just to highlight maybe the risks of share buybacks. Different structure, different consequence. So I'm going to run through, we've got about 10 minutes left. Just going to run through some thoughts on your single business owners or professionals, because we tend to forget about them. Think of your doctor who's been in practice for 40 years and the ladies that have worked in his practice for 40 years. We need to consider the format in which the business or the practice is run. Often they're sole proprietors, which means it can't really continue. And if we wanted to continue, how do we facilitate that? We also need to look at if that business is transferable. Think of your own businesses as financial advisors. What happens to your business and the value of your business when you're not here? How do we extract a possible value? Let's have a continuation discussion with our clients and decide how we're going to solve for that. So we might have a situation where we say, okay, fine, the business will not continue. So we need to plan for it to close its doors, and that's very important. Or we might say, you know what, yes, the business has a potential to carry on with a team of people or a team of employees, however we solve that. So let's plan for that accordingly. Okay, I'm going to very briefly just go into the income tax consequences. There are often misconceptions around the income tax and the estate duty. So when you receive my slides and you go through it quickly, I say always put it in a box and apply the rules of that box to the particular need that you're trying to solve. So from an income tax perspective, there's this section 11W2, and that's the only section under which you could possibly deduct any premiums paid on business assurance. Now, there's a whole list of requirements, and you'll see if you look at it with your legal eyes, it's got 1 and number 2 and number 3 and number 4 and number 5, which means we need to comply to all 4 of these requirements to be able to deduct the premium. Now, if you look at the risks that we spoke about earlier today, and we look at covering that, you'll see that all your risks will always meet the first three requirements. There's a risk benefit, there's no cash value, and the company or the employer owns the premium, except for buy and sell. All right, so the important point here is there's a little box on the application form that you will tick to say whether you want to deduct or not to deduct the premiums. And what we're saying here is if you look at the deduction, the consequences of deducting it, if you deduct a premium, you'll pay tax on the proceeds. If you're not deducting the premium, the proceeds will be tax-free. But the reality is if you read the note from SARS said that they will only allow you to deduct under 11W. Proceeds, premiums on policies that you are going to use that will not be of a capital nature or intended to cover a capital obligation. So if you look at surety policies or you look at loan account policies, they are all intended to provide capital to extinguish a capital debt. So our recommendation is not to deduct these premiums because you will not qualify for them. And even if it slips through, there'll be a recovery of that afterwards. The only premiums or products or solutions that you will have a choice to deduct legally will be, and that is not of a capital nature or to extinguish a capital objective, would be your key person policy, because you're not going to use the funds, the proceeds from the policy, to extinguish a capital debt. You're going to use it to ride out your losses or appoint another person. Okay, I just want to see what's happened to my estate duty. Here we go. Okay, so that's the income tax consequences from an estate duty perspective. Again, you'll see two sets of requirements. So if you look at the Estate Duty Act, you'll see Section 33A says any policy that's owned by another person on the life of the deceased is a deemed asset. And this is the most difficult consequence or concept to explain to clients. It's not my policy, the money pays to the company, why must I pay estate duty? And the reason for that is Section 33A that says it's on your life. And therefore, there's two exemptions. You'll see the one is for key person policies and the other one is for buy and sell. So keep the requirements very separate. Let's look first at what is termed by the legislator as key person policies. You can in fact say company owned. So any company owned policy that was not affected by the deceased and where no premium was paid by the deceased and where no amount is due or recoverable under the policy and was not used to benefit a relative in a family company, those will be exempt. Now, the definition for family company is quite a difficult one, and I'm not going to read through it now, but we need to know that there's various interpretations of family company. If you look at a company at any relevant time, that could take it back to inception of the company, where we try and determine 50 or more % of the shares. And you'll see it says controlled or capable of being controlled. It also says directly or indirectly by means of majority share. And we also look at deceased or by the deceased and one or more relatives. And if you look at the definition for relative, you'll see that it even includes someone that's connected to you within spousal relationships. And we look at 3 degrees. So it's very difficult in our interpretation. And also if you read SAR's practice note to qualify for the exemption. Okay. So you'll see then in our provision, the system automatically will quantify and put on top of your cover the amount of estate duty if and where it's necessary. Okay, so that's our company-owned policies. I want to talk to you about buy and sell. I always call them the 3 Ps, and you'll see there different section in the Estate Duty Act, and you'll see we don't talk here about family company. So again, when you go back and you look at the slides, keep the requirements separate, then it's actually very easy to understand and to know when to provide benefits. So here we say for a buy and sell policy to be exempt, it needs to be taken out by the partner of the deceased at the date of death. So obviously you need it to be partners at inception because that's your insurable interest, but you also still need to be partners when the life assured dies. And number 2, the policy was taken out with the purpose of acquiring all or part of the deceased's interest. Okay, so not to fund anything else like a surety or whatever else people include. And then the last requirement that we're all familiar with is that no premium on this policy should have been paid by the deceased. Okay, so if you say purpose partner premium, it's actually very easy. If one of the partners then own their shares in a holding company or in a trust, we know that that link is broken because the entity holds the shares and not the life assured. Okay, so very easy to see and apply that as well. You'll see here we say that this exemption is only available to natural persons. So as soon as someone holds their interest in the business in a company or another CC or a trust, they lose that exemption. Okay, so just some concluding remarks, and I see I have 2 minutes left. Here's just our business assurance in the order in which we would address the risks again. Our sureties, our loan accounts, our equity discussions as first priority in that order. Even if number 1 and number 2 is 0. You want to have the conversation. And then as a second priority, our key persons, our debit loans, our overheads, and the income that we need to protect from these businesses. That has brought me to the end of the presentation, literally 2 minutes before closing time. So I'm just going to allow you, if there are any other questions, post them on the chat. I'll try and answer them quickly. And while you're busy with that, Richard, thank you. I'm going to hand back to you.